Hi, guys. Welcome back to another episode of Trader in Training with me, Hannah, and then, I'm like looking at the camera, and then Renato. And today we have a special guest, Michael.
I'm here. Yeah. How we doing?
I'm doing good.
What is going on, sir?
So what are we going over today?
Yeah, so during our first meeting, we discussed a little bit, kind of introduce ourselves and talked about our intentions and trying to, what are some of the motivations for getting involved in markets, why you should not be involved in markets at our age and so on. We talked about the different markets that are out there, stock, bond, commodity, derivatives markets, over-the-counter markets, and talking about things like swaps, why an institution would use swaps, right, to swap out risks they may have in their portfolio. We talked about the banking crisis and so on, all that kind of stuff. And we talked about alternatives like, having like whole life insurance and stuff like that. Taking money or being able to borrow money against that and so on. So tons of alternatives out there and reasons to or to not be involved in markets. And today we're going to assume that we really want to get involved in markets. So we're going to talk a little bit about, those things in more detail. So, different analysis techniques, how you uncover winning trades. I think there's three main ways I look at the market, and the latter two are more important to me than the first one, but fundamental, technical, and positional analyses. And, we'll kind of go through all those real briefly today, and then we'll set the stage for the next conversation where we start going into more detail, particularly on the latter two, which are most important to me. Is that okay?
Yeah, sounds good to me.
Cool. So starting with fundamental analysis, really, when you're doing fundamental analysis, you're looking at a company's financial health, their position in the industry. You're talking about competitive advantages. You're talking about, what does the management team look like? We'll talk about, having someone like a Steve Jobs or like a Tim Cook, and why you need both or one of the other on when you're looking at a company. Why would you want to have one or the other, and how do they, how are they important to a company and their future growth potential, right? So let's start off with the financial health, and so we start off with the financial statements. And we'll keep things kind of naive, and then we'll decide whether or not in a future episode, we'll go into depth about like, okay, how are you actually calculating these things or whatever. A lot of this stuff you can honestly find on Google and stuff like that, as terrible as that sounds to say it, but there's tons of great information out there. So we're just trying to
YouTube tutorials that you can learn everything from.
Yeah. So we're just trying to make people aware, and then, whatever they do with that information is their choice. So, a balance sheet, is kind of a snapshot, assets, liabilities, shareholders, equity, and really you're trying to figure out, what is a company's liquidity position? Are they solvent?
What is a liquidity position?
Liquidity is like, do they have cash to kind of finance the operations, right? If you own a house, can you take that money and like apply it towards something else, right? You're not, you might have a lot of equity, but you're not liquid. Liquid is as in like, if you're highly liquid, you might have a lot of cash where you can throw that cash into areas where you need to address things. Does that kind of help you start to understand? Michael, would you like to maybe add something to that?
No, yeah, that's a really good point. I mean, it's I'll go with the real estate analogy again too, because you mentioned it, right? Like if you own a home and you have a mortgage on the house, let's say you have a $200,000 mortgage, you have payments, of course, that you're going to make on that mortgage every month, right? And as you pay down that mortgage, you're going to get what's called equity. So you've got equity coming into this house where you paid down the amount that you owe, but the house is still worth X, at least according to the market. So if you pay down your mortgage to the point where you owe $130,000, you now have $70,000 in equity, according to what the market says your house is worth. So it's not cash on hand, but you now have the ability to loan against that equity in your home. And it's basically the same way when you're looking at balance sheets and cash, right? You may have cash on hand, but you can also have assets that give you equity or give you value. At least that's,
Okay. Yeah. This makes sense. I understand.
Having those assets doesn't mean that you're liquid, right? There's still, there's barriers in the way of you leveraging that money. So that kind of explains that. But that's why it's important to kind of analyze, how much cash and cash equivalents does a company have? What are their debt levels, right? accounts receivable, and so on. A strong balance sheet should have kind of an adequate amount of cash and cash equivalents to meet short-term obligations and fund operations, right?
Okay.
So having a healthy amount of current assets to current liabilities, having kind of that top number, that numerator higher than the denominator is a good thing, right? Current assets over current liabilities.
Okay.
Assets can be tangible or intangible. A tangible asset may be something along the lines of having a house, or like a warehouse, can be plant, equipment, stuff like that. An intangible asset, and that could provide long-term growth and so on, is a patent, is trademarks, and so on.
Okay.
So that's all kind of, bunched up in there. Then you have something called income statements. And income statements are basically like, profit and loss. So you're looking at companies' revenues, expenses, net income over a period. You don't want to see net losses. You don't want to see falling revenues. You don't want to see inconsistent earnings.
I would love to see Benzinga's income statement.
Oh.
You don't want to see higher costs, excessive debt levels. You don't want to be growing faster than revenues or profits. Like, these are some basic things when you're looking at these statements to think about when you're analyzing a company. So remember how last time we said, hey, pick a field that you're passionate about. So maybe it might be fashion and arts. And then once you pick that field, you start kind of diving in. Okay, here are the different stocks that are out there, and these are how they compare to each other.
How do I
This one is
know?
burning money. This one is in a better position in terms of like the assets that they have. Maybe their revenues aren't falling over time. Go ahead.
Okay, I was gonna ask, how do I know that it's like a good stock to invest in? Like, does that have to do with like its losses and like the income that it's bringing in?
We'll get to that.
Okay.
But that is a valid point. So that kind of gives you kind of the income statement, right? Not having research and development. What does that mean for the future prospects for the company, right?
Mm-hmm.
Right. If they're not researching and developing, like, is that a promising investment?
Probably not. No.
Yep.
I would
So
not feel comfortable
basic things,
investing in
trying to keep things basic, right?
So I know what an income statement is.
Okay, cash flow, inflows and outflows of cash. You don't want to have negative cash flows or cash flows that continue falling in perpetuity. You don't want excessive expenditures and heavy financing. Then, we talk about industry position, right? What is their competitive advantage, strengths? Is it technology? Is it brand? Is it leadership? Is it, innovation? Are there barriers to entering and competing with those companies? In fashion, I keep bringing up fashion. I don't know why, but
That's okay. I like fashion.
in fashion,
analogy.
the barriers might be lighter than aerospace and defense, right?
I don't know anything about aerospace and defense.
Exactly. So you could a naive way of looking at that would be like, there's probably more barriers to enter that sort of market than there is, fashion, right? So,
Okay.
and so if you are a dominant player in the aerospace, what is the and defense? What is the probability that you maintain that dominance over a long term? Whereas if you're like a clothing brand or something like that, it might be harder to keep that competitive advantage because there's not so many barriers to entering, right?
No, that makes sense.
And barriers can again be like, is there certain filings that they have to have, or what? I'm just making up stuff, but that kind of makes sense. Then you have the management team, right? Do you have someone who's creative, like Steve Jobs, right? And then do you have someone that's behind the scenes, like a Tim Cook, right? It is very great to have, artistic and creative people were, at kind of the forefront and the basically the face of the brand, but you need people
interesting.
You need people behind the scenes who are
Benzinga.
silent killers who are executing.
Okay.
People, the Michaels of the world, that
world.
are grinding away, digging their grave. And
I don't know that I like the sound of that. But yeah. Michaels of the world.
But I'm just playing, having fun. But does that make sense? You need to also be cognizant of those things.
Yeah. No,
that's not a numbers thing. That is like that might just be like your understanding of that industry. That's why it's so important when you're going into these things is to understand, be well acquainted with that industry and understand who are these people at the top, what are their competencies and so on, right?
So like, what are you guys invested in? Like what kind of companies?
That's a good question. Well, I think you make a really good point, for one, where it's so important not just to understand the fundamentals of your investments and the backbone to the numbers and the technical indicators and everything else that goes into investing, but the industry itself and the people that actually make up the investments, right? Because I fully believe that at least a good portion, 30 or 40% of your investment should be based on the philosophy and the people that are running these investments as much as it is about the numbers, right? A lot of people are invested in the EV industry, like Tesla and the electric automakers that we have. And a lot of people do that strictly because they like Elon Musk. They like his vision, and they like what he stands for. They like his ingenuitive spirit. And I think that's
an interesting guy.
He is a very unique character, no doubt. Like for me, I personally, I don't like the artificial intelligence industry necessarily for many reasons, but I do think it has a lot of applications. And I think it's growing very quickly. And I think it's going to transform a lot of the ways that we do business. And I think that that's an industry worth investing in for the long-term growth. Like I hold companies like NVIDIA, AMD, Marvel Technologies, stuff like that, because I think that they have the framework and the tools in place to be able to grow the artificial intelligence industry over time. Yeah. So I want to invest in it now and let that grow as it goes. So I invest in industries that I think have a promising future.
See, that's what I've heard a lot of, is like it's better to invest in things that you think are going to grow, because then there's like more room for growth and like gaining more money, rather than like investing in like Apple, who's already a company that's like so established, and yes, they're going to grow, but not in like large increments.
Here's another thing to consider. When you're putting money into the market, you're not putting money into a machine and, a slot machine. You're giving this money, and people are in control of that money. What those people are doing, they might be allocating it to research and development and so on, but it's very important to understand, where are those people coming from, right? What are their intentions, right? Who are they as people? Like an Elon Musk might be all gas, no brakes, right? In terms of research and development, but, does that kind of make sense?
No, that makes sense.
Okay. In terms of other analysis techniques, you have technical analysis, and many people like to knock on technical analysis, but I think it works pretty well, because if enough people think it does, it's kind of a self-fulfilling thing, right? So they're inclined to act in a way that actually results in there being like self-fulfilling tendencies. So technical analysis is viewing the market and acting on what you see visually on a chart. So say there is, and we can maybe look at this one day, because I have tools to make this.
Yeah, we definitely should, because I have no idea how to read any of those charts.
So
they look like foreign language.
I'm going to say the term resting liquidity. And what that means is there's a bunch of orders resting in the market at a certain level. So let's say there's a bunch of resting liquidity. The market is, let's say we're referring to the S&P 500, and the S&P 500 is trading at a certain level. Above that level, there's a bunch of resting liquidity. That's just a bunch of resting orders in the book, right? That are waiting to get executed or filled, right? Now, let's say that liquidity may result in some resistance that you can visualize in a price, because those people are, sell to close orders or whatever, sell to open orders, right? Okay. So you're going to hit that and then come bounce off, right? And you can see that visually on a chart. You can, so that's what that is, right? You see a level, right? Why is it?
I can see that.
Why is it stopping there? It's not stopping there because there's a line. It's stopping there because there's just a lot of people who have a bunch of orders at that level, right? So that's a way to think about.
How backed up can it get? Like how many orders?
There can be tons of orders. We'll get into that because we're running out of time.
Okay.
But the same thing happens in support. You may have a ton of resting buy orders below the market, and so the market will hit that level until it cracks and maybe moves through, and then those buy orders start flipping and people start panicking and they start selling. Whatever. We'll get into that. Then you have, when you have a consolidation, right? You've seen a chart and maybe prices get into like a little cone, right? That's a period when traders are positioning themselves for the next big move, or maybe betting against volatility, betting against market movement. So there's a very mechanical process that is happening underneath the surface when I'm talking about that.
Okay.
Think, for example, what I just said, betting against volatility. So what does that mean? If you sell volatility, which we said our first episode, volatility, is kind of like the colloquial reference to options. That basically means you're like selling options. So think if you sell a call and or a put, the counterparty is long a call or a put. So I'm going to end it pretty much at this because I'm going to have to jump for a call, and then maybe we can come back later today if you want, or we can
I'm going to the golf course, so I won't be here.
Okay.
You guys are welcome.
That's okay.
Yeah, we can either come back or we can just do it next episode.
So I'll just end on this. So when we're talking about sell volatility, you're basically betting against the market as a trader. The counterparty who's taking the other side of that trade is going to hedge in a manner that will reduce volatility as those options near expiry.
Okay.
The options delta, which is its exposure to direction, grows, and that just means that those mean reverting forces are going to increase in power, and so you start to get even more of a consolidation.
Okay.
But there might be some news that shocks the market out of that consolidation and starts hitting things and they start going in a certain direction, or there might be an options expiration, which we get to when we talk about positional analyses.
Okay, cool.
And so that kind of ties it up for that. In terms of positional analysis, that's where I put a lot of time in. Working in equity options analysis. So that's basically we're using that analysis to forecast the direction or the volatility of the market. And then I was going to get into reasons why, the market traded the way it traded in 2021 and 2022 based and from a positional analysis perspective, but we're just not going to have time at this moment. But let's table this either for later today or the next time we meet. Is that okay?
Yeah, sounds good to me.
Awesome. Do you have any big questions before we hop off?
I don't think so. Today was fun.
But it's kind of clicking slowly.
Yeah.
We'll give examples in time.
Where do you get your haircut?
Where do I get my haircut? There's a
very big on your guy.
He's kind of been letting me down a little bit recently. I feel like he's losing his edge. And you always have a very clean cut.
I appreciate that, man.
Where do you get the
the place is called Headquarters Haircuts for Men. It's actually just close by where my parents live, so I just go there.
Well, guys, so we're gonna close it out.
Okay.
If you need a haircut recommendation, you got it right there. So check it out. Thank you for coming to this week's episode of Trader in Training, and thank you for being our guest for the week, Michael.
Absolutely.
We will see you guys next week. Bye.
Bye.